We are back with Eric Robertsen at Standard Chartered Bank, who is still with us live. And Eric, we left off talking about solutions, how you deal with this huge mountain of debt that the world has piled up because of fiscal spending, crucial, necessary fiscal spending to fight the coronavirus. We've talked about raising revenue, higher taxes, Janet Yellen's idea of a minimum global corporate tax. We've talked about bond issuance and central banks and their ability or capacity to hoover up that debt to keep yields down. Third and pretty obvious way is to grow yourself out of a debt problem. Fourth, let's say the United States, let's start there if we could. Is the debt that's piled up so big that an economy growing even in excess of 6%, a large mature economy, the biggest in the world, growing at 6% or in excess of that, that still wouldn't be fast enough to take care of the debt?
Well, Martin, look, this is an important question, and I think different economies around the world are, trying to address this issue in different ways. If you look at the United States, 2/3 of growth is from the U.S. consumer. And the U.S. administration has made a big bet on that, right? We've had $1.9 trillion of fiscal stimulus passed recently. A lot of that is income supportive. And so they're hoping or betting that the U.S. consumer, when the economy reopens, is really going to drive the U.S. economic recovery. The fear or the risk is that consumer spending may surge in the early days of the recovery, but perhaps is not medium-term sustainable if you don't see a similar improvement in labor market prospects. China's taken a slightly different approach. They have focused on their fiscal stimulus on infrastructure and a number of other investment and capex-related measures, more targeted measures, including the consumer. But I think they're making a bet on trying to improve the productive capacity of their economy. And so in the short term, you'll see China's economic outlook, I think, continue to outpace the U.S. But as you say, Martin, the really critical question 2-3 years from now is where are we seeing sustainable growth that allows countries to perhaps grow their way out of the debt pile?
Yeah, and Eric, you make a point in some of the notes I've seen that if you take a look at the headlines and sort of it's almost by right because it is still the world's #1 economy, right? It seems as though the U.S. is going to lead the world out of this pit that the coronavirus has dug us into, but that's not necessarily the case because the world's #2 economy, China, first in, first out, is posting some very, very impressive numbers. You throw India in there as well, but I want to challenge you on that because we've been talking about the explosion of coronavirus infection numbers in an economy the size and scale of India. And it's not just India, it's every single economy in the world. Whatever recovery trajectory they're on could be like that, dashed, if the coronavirus comes and bites everybody in the back again.
Well, Martin, look, you've obviously highlighted the sort of critical risk to the global economic recovery this year. We have a relatively constructive view on the economic outlook, although we have made it quite clear that we think the recovery will be bumpy, noisy, and quote-unquote uneven. And part of the risks around that noisy or uneven recovery does come from these flare-ups of second and third waves of COVID. The thing that I would highlight is that I do believe each successive flare-up in COVID will lead to less economic damage. In other words, the first time it happened, we see national lockdowns for 1, 2, or 3 months. And each successive flare-up of COVID tends to lead to a less dramatic policy response. I would acknowledge that India is seeing a third wave of infection cases. That does leave us concerned. But again, to your earlier point, if I look across Asia, China and India included, where we are seeing a handful of infection situations flare up again, I still believe that that's going to be the engine of growth for the global economy this year, reaching nearly 8%. So I think there's still a very compelling case of seeing Asia match or even exceed the U.S. growth recovery.
Eric, can I push back on that a bit and ask you whether you think there is almost a perfect storm brewing for emerging markets and emerging market currency space when you consider the higher yield environment and the stronger dollar? Or are we better positioned and more resilient than we were in previous bouts of turmoil back in 2013, 2018?
Well, I wouldn't call it a perfect storm, Sri. I mean, there are aspects of today's economic recovery that I think are extremely supportive for emerging markets. One is from an external vulnerability point of view, most of EM is in much better shape today than it was in 2013 during the taper tantrum. We've seen a significant increase in emerging market trade. Emerging market economies trading more and more with each other than ever before. I think that speaks to the sustainability of the economic recovery. We have yet to see a surge in investor flows back to EM to take advantage of this. And I think that's purely because of the increase in US interest rates, some fears around Fed tightening, and frankly, fear around US or even global inflation. But we have argued that when US interest rates stabilize, that will become a platform for a return of capital to EM, especially in Asia.
Eric, super quickly, back to China. Where does this all leave the yuan, especially when you consider bilateral relations? They are going backward. And the recovery there, I've got to say, remains quite uneven.
Well, look, we are relatively constructive on China, both on the economic outlook and on the currency. And there's a couple of factors there. Number one, I would argue that the breadth of the recovery is growing or improving. There have been some concerns that China's exports would slow down as the rest of the world normalized. I don't think that's correct. I think you're seeing an improvement, an increased diversity in China's trade statistics that augurs well for their economy. And look, the reality is that while China was first in, first out from the COVID crisis, they didn't throw the kitchen sink at the economy in terms of liquidity and leverage the way they have in the past. So the proverbial hangover afterwards, I think, is going to be less dramatic. So I think you're seeing a very healthy and sustained pace of growth. I think that's going to create a very stable environment for the currency. And you can already see that. China's currency is very low vol relative to its peers.
Eric, fantastic as always. Thank you very much indeed, sir, for your time today. Eric Robertsen there of Standard Chartered Bank.